Alright, today is Wednesday, February 10th, and this is a post market review and analysis for the stock market activities today. What were the market's dynamics today? Early in the morning, pre-market and the futures were pretty much muted, doing absolutely nothing. The market is running out of momentum, is running out of steam. The retail trader has already been slaughtered in GameStop and the likes. There are pockets of the retail trader that are still alive, but again, they're participating in the same stupidity of pumping crypto and then weed stocks and who knows what next. It's the same playbook that happened with the heavily shorted stocks. But all in all, the institution bought the dip and they pumped the market higher. Every pocket in the market, whether it's the Qs, the IWM, chips, it didn't matter. The inflows found their way in the market, and now we're running out of steam. There is no new blood to pump the market higher, and there are no catalysts to pump this market higher beside passing the stimulus. We got a little bit of excitement in the morning after being muted throughout the session. We're talking about the pre-market session, of course, until we received the CPI inflation data. And it was a Fugazi number showing that inflation is picking up slightly higher. Just slightly, just a baby touch higher. And you saw yields diving down right away and stock futures blasting higher. And of course, the devil is always in the details. When you dig deeper into the data, you find out what actually was hidden from the report. And we will cover that and a lot more during the headlines of the day segment. But the moral of the story here is, after a significant surge higher in the market, broadly speaking, in a short amount of time, we're talking about a week or so, you become more susceptible for negative news to drive the market lower. The question is, where will negative news come from? Once again, a compromise regarding the stimulus. When we talk about compromise, we're talking about a less than expected stimulus. It could be news regarding the virus. It could be any factor. It doesn't matter. What matters is, after a massive run in a short amount of time, you start to run out of steam, you become more susceptible for a sell-off due to any bad news. We're also almost done with corporate earnings, and the majority of earnings have exceeded expectations. The problem is the market is not so excited about the beats, and the reason is they're all already priced in where the market is trading. So we enter this boredom period of the market, the silence before the storm. Could be a storm higher or could be lower, depending on what kind of news we're going to receive next. Furthermore, a lot of traders have been asking how to spot a reversal in the broader market. Number one, it could happen in the pre-market. You see a massive sell-off, a gap lower, and we continue to sell off from that point on. That rarely happens these days, because if it happens, it will be some virus news or news from overseas regarding China, Iran, etc. The most likely scenario, however, is what we call a gap and crap scenario, meaning that you gap higher in the morning and then you flush down, closing at the lows of the session, and then you continue to see red day after that. The question is, was today a start of a gap and crap reversal? Early in the morning it started to look like that, but then we started to recover thanks to remarks from Federal Reserve Chairman Jerome Powell. We're not going to know if this is the gap and crap reversal until we trade tomorrow. But you have to keep that one in mind. Lastly, before we dive into the market coverage, what about the Reddit rebellion? We saw some of the names, the GameStops of the world, trading a little higher. But for all intents and purposes, the rebellion is dead and the Reddit crowd is migrating somewhere else. Whoever is still alive, they migrated to the weed territory right now, pumping weed stocks. But the moral of the story here is the following. Here is a chart indicating the massive decline in GameStop short float. And this is to the new traders, young traders who just joined the market recently since the March bottom of last year. Whoever been telling you that you should hold on to your shares in GameStop or continue to buy it even at outlandish levels of $300 and $400 due to the high short float and all of that had to be covered, etc., etc. They were lying to you. The short float means nothing. Absolutely nothing. At the height of the short float, the reading was about 115%. The reading right now is below 40%. So we saw massive short covering activities taking place the last few weeks. With that being said, the stock has lost about 90% of its value from the top, meaning that short covering did not matter whatsoever. And the reason is the tsunami of selling. Everybody who bought the hype is now panicking and dumping their shares. For every share that is being short covered, there are 5 shares being sold. And what about the holy war against hedge funds? Are they damaged after all of this? Of course not. Here's a list of the top 15 earnings managers. We're talking about hedge funds in 2020. They have made over $23.2 billion in profits. Of course, the guy that the Reddit crowd picked on is Gabe Plotkin of Melvin Capital, and this guy is the smallest fish in the pond. The big guys all made a killing from the whole GameStop story. With that being said, we do have a market to cover, and here we go. The Dow Industrial Average closing in the green by 61.97 points, or a gain of 0.20%. The Nasdaq closing in the red by 35.16 points, or a decline of 0.25%. The S&P 500 closing in the red, down by 1.35 points, or a decline of 0.3%. What about the sector's performances? Leading the pack and capturing the gold medal, energy for the second place, and the silver medal, communication services, and the third place, capturing the bronze medal, real estate. The laggards of the day, led by industrials, consumer cyclicals, and consumer defensives. No particular theme whatsoever here, but as we see the decline of the US dollar, that becomes another tailwind for energy stocks to rise higher. Moving on to the futures market performance for the day, let's see what happened here. While the energy sector, in terms of the stock market, outperformed today, crude prices remained muted throughout the session. Both the WTI and Brent closing flat for the session. What about softs? The gainers of the day led by coca and sugar futures. Meanwhile, we saw muted activities for OJ and lumber, while cotton and coffee futures led the declines today. What about metals? Gold muted, silver is the underperformer here, down over 1%. Meanwhile, massive gains for platinum, copper, and palladium. What about meats? The explosion higher in the lean hogs futures goes on and on and on. No stopping sign. Feeder cattle, a decent session today, up about 1% or so. Meanwhile, live cattle, the opposite picture, down about 1% or so. The bulk of the declines in futures today came from grains, and it is about time. They've been outperforming significantly, causing a hunger crisis in America. But today we saw declines, massive ones, for soybean products, soybean futures, corn futures, wheat, oats, canola. The only outperformer here, rough rice futures, and they did so by closing flat. Moving on to the big casino, the options market. Let's see what happened today. The casino remains very quiet. The last few days, no activities whatsoever. The tables are kind of empty. And that is another indication that the retail trader got slaughtered in GameStop and AMC. They went all in, Naruto style, heads first, and they're now stuck. They don't have any more money to gamble with. But fingers crossed, because the Biden administration is perhaps getting closer to passing the $1,400 stimulus checks, and that will add more bonus chips on the table for the players in the casino. But here is what happened today. Leading the pack, number one, the Sundial Growers. This is a wheat company. It is catching a bid due to the Reddit crowd pumping wheat stocks. And they are targeting this particular company because it is very cheap. The stock is trading at about $3 a piece, yet these morons are buying options that happen to be more expensive than the underlying price, the price of the underlying stock. Doesn't make sense at all. At all. When you see something like this, you buy the stock and you continue to sell upside calls to raise cash until you get called and you sell your shares at a profit. You don't gamble by buying naked calls that cost you more than the price of the stock. But this is the SPAC generation that invaded the market as of late. Anyhow, the options volume for sundial growers was about 1.8 million contracts trading today. About 87% of those were calls. Coming up at number 2, Apple, with about 1 million contracts. 71% of those were calls. At number 3, Tesla, and we saw a slight uptick here in the options volume for Tesla. 860,000 contracts. About 36% of those are calls. Massive shift in momentum here for Tesla, because we're talking about 64% of the options traded today as put options betting for a downside move in Tesla shares. And of course, the Tesla CEO is very busy pumping Bitcoin, Dogecoin, pretty soon wheat stocks. He's going to join the mania. You can bet on that. But he is ignoring his own company, and we know that the competition is heating up by the day, and this man is losing focus altogether. And perhaps that is shaking the investor confidence in the company. And the last theme here to discuss is Nvidia. Nvidia has been dormant, doing absolutely nothing since September of last year. And we know that Nvidia is about to report earnings. And of course, what traders are doing is participating in the donkey mentality. What is the donkey mentality? It is buy first, ask questions later. Matter of fact, don't ask questions at all. Just put your blindfold on and buy. And you saw that with Apple buying the shares before earnings, and that did not work. Now they're doing it with Disney and Nvidia, and they did it with MGM. So the question is, how do you capitalize on the donkey mentality? You do what I did today. For example, today I sold out of the money calls for MGM Resorts expiring this Friday because the stock is trading pretty much above its pre-pandemic highs, and we know that the business has not recovered yet. Yet they continue to buy it for whatever reason, and they were buying a ton of call options throughout the week, playing the earnings. Me, I sold them these calls, and you're seeing the reaction after hours. MGM is down, the volatility will cool off tomorrow, and the likelihood is I will capture the credit I received from selling those calls. Here's another strategy, and I did that today as well. I bought Nvidia shares, 100 shares to be exact, and I sold upside calls expiring this week, and I will continue to do so until earnings. And the goal here is to capture short-term profit to exploit the rise of demand in buying call options for Nvidia. We don't know if Nvidia is going to explode higher after earnings or not. That doesn't matter. The strategy here for you is to exploit the trend that is going on. You can do the same thing with Disney, sundial growers, whatever stock that is catching a bit. But of course, it makes more sense with sundial growers because the stock is trading at $3 a piece. You buy a few hundred shares and you sell those call options and you capture significant amount of money. And if the stock continues to skyrocket higher, you will get called, you will sell those shares at a profit. Who cares? You're not in love with the name. You're just exploiting what's going on right now in the market. But let's move on and cover the unusual activities that took place in the options market today, starting with Nvidia. They're buying the 625 calls, expiration date April 16th, with expectation that the name is going to rally over 6% by then, and they are paying big bucks for this one, by $33.5 a piece, and that brings the total to about $10.5 million. Now, what about the trade for the Qs? Somebody's making a bearish bet here, buying the 314 puts, expiration date February 26, with expectation that the Qs will decline over 6% by then. And they are paying about $1.77 a piece to enter this trade, and that brings the total to about $2.5 million. What about the ticker HIMX? This is for a Taiwanese company called Himax Technologies, and the trader is making a bearish bet here, buying the $14 puts, expiration date March 19th, with expectation that the name is going to decline over 8% by then, and they are paying about $1.25 a piece to enter this trade. That brings the total to about $1.5 million. What about the ticker PENN? This is for Penn National Gaming. They continue to buy upside calls for this name, spending big bucks. This time around, the trader is buying the 130 calls, expiration date February 26, with expectation that the name is going to rally over 13% or so by then, and they are paying $2.40 a piece to enter this trade. That brings the total all the way to about $1.7 million. What about the ticker CRWD? This is for CrowdStrike. And they are making a bullish bid here, buying the 245 calls, expiration date February 26, with the expectation that the name is going to rally over 7% by then. They're paying big bucks for this one, about $4.70. That brings the total to $3 million. What about the ticker LI? This is for Lee Auto. We continue to see upside calls for Lee Auto going on pretty much every day throughout the week. They're buying the 35 calls, expiration date March 5th, with expectation that the name is going to rally over 12% by then, and they are paying about $2 a piece to enter this trade, and that brings the total to about $1 million. What about Cody? Cody got smacked yesterday after reporting earnings, and the consensus here is that the company is struggling. However, it is one of the so-called nostalgia names that I showed you during last video. These are the kind of names that you want to buy bidding on the reopening and the normalization of the economy. We're looking for value here. We're looking for companies that still have room to rally before reaching their pre-pandemic highs. There are very few names left in the market that fit this description. One of them is Cody. Now, understand that the earnings report was abysmal, but regardless, the bet here is that this is the bottom, the worst is behind, and we will see upside momentum from here on for Cody as we reopen the economy. And I am thinking about buying the name, but I will do it exactly as this trader is doing, by buying the 7.5 calls, expiration date March 26, with expectation that the name is going to rally over 13.5% by then, and they are paying about 50 cents a piece to enter this trade, and that brings the total all the way to about $500,000. Instead of buying the shares and then suffer more declines if we have more bad news, why not buy the call option, and if it happens that the stock moves all the way where you expect it to, you convert those call options into stock. And here's the last trade for the day. For the ticker NET, this is for Cloudflare. We're seeing a lot of activities going on for this name, and in this case, they're buying the 105 calls, expiration date March 19th, with expectation that the name is going to rally over 16% or so, and they are paying about $4.30 a piece to enter the trade. That brings the total all the way to $2 million. Moving on to the headlines that shape the day, starting with macro news. And right away we heard the core CPI inflation data, and it came pretty much unchanged. It risen about 0.3%. Which is nothing according to the report. However, we know that inflation is rising on steroids around us. Look no further for food prices. Of course, the Fed is in denial and continues to use these outdated formulas and outdated models to calculate inflation. No wonder why they cannot see it anywhere. But here it is. Why is CPI so low? Rent inflation drops to 1.84% year over year. Shelter inflation drops 2.05%, both the lowest since August 2011. New York rental collapse is why the Fed will keep inflating the biggest asset bubble for years. Here is more. U.S. core CPI on the low side at 1.4%. Many opposing forces in month-to-month numbers, but trend-wise it is rent of shelter that looks weirdly low year over year compared with underlying rent indicators. It has a 40% weight in core CPI. So it matters big time, meaning that inflation is rising all around us significantly. However, rent prices in New York and San Francisco dropped significantly for understandable reasons. Who wants to live in those cesspools after this pandemic? And the Fed somehow calculates rent prices dropping in New York, San Francisco, and the rent of shelter, which has over 40% weighting in the entire formula. When that drops, no wonder why the core inflation CPI is going to read a lower reading. Meanwhile, here is the devil in the details. And this is from the Bureau of Labor Statistics. The Food at Home Index increased 3.7% over the past 12 months. All 6 major grocery store food group indices increased over the period, with increases ranging from 2.5%, this is for cereal and bakery products, to 5.1% for meats, poultry, fish, and eggs. The index for food away from home rose 3.9% over the last year. The index for limited service meals rose 6.2%, the largest 12-month increase in the history of the index, which began in 1997. The index for full-service meals rose 2.9% over the last 12 months. So gas prices are up, food prices are up, home prices are up, asset prices are up, equity prices are up, utilities are up. It doesn't matter for the Fed. They're blind. They use these tilted formulas to give you the illusion that inflation is not rising. And of course, we know when the Fed is going to have to intervene, when, God forbid, your wages start to increase. And since Jerome Powell cannot see any inflation going on in the economy, and I just showed you the reality about the inflation in food prices, here is the end result. And this is very, very tragic. The U.S. children poverty rate is surging higher. We now have a children poverty crisis in the richest country in the world. Thank you to the Federal Reserve. So long as the assets of the wealthy, stocks and real estate, continue to skyrocket higher, the Fed is satisfied. But when we have a hunger crisis in America, a child poverty crisis, a housing crisis, a wealth inequality gap crisis, that doesn't matter to the Federal Reserve whatsoever. That is not their mandate. Their mandate is to prop up and inflate the assets of the wealthy. Moving on to more updates on the stimulus package from the Joe Biden administration, aka the BlackRock administration. And here it is, Biden yelling to discuss the $1.9 trillion COVID relief plan with, here it is, JP Morgan, Walmart, Gap CEOs. They have to take the blessing and the approval from the true rulers of this country. What do you think Jamie Dimon and Walmart CEO are going to say to Joe Biden? They will say, if you raise the minimum wage, we're going to have to fire employees, blackmailing the government once again that these corporations that the taxpayer have bailed out and the government showered with trillions and trillions of dollars of helicopter money are now saying, God forbid we have to pay our employees a living wage. Then we have to give some of our employees the boot and have them be dependent on government welfare. Well, we know from data that the biggest recipients of food stamps are Amazon and Walmart employees because they're not paid a living wage. And here it is. Wall Street is throwing a fit. 1/3 of small business owners say 50 minimum wage will result in layoffs, survey says. Here's the difference, and here's the problem, really. We keep electing these incompetent donkeys to run for office and run our affairs. They cannot use any critical thinking whatsoever to differentiate between small business and big business, between small states and bigger states, meaning that a $15 minimum wage makes sense in California, New York, Washington, etc., the larger populated states. It does not make sense in smaller states, Alabama, Mississippi, etc. So how about we come up with a formula that is indiscriminatory and will raise the minimum wage where it is needed, depending on the cost of living. And by the way, a lot of people don't like increasing the minimum wage. I heard it in the comments saying that increasing the minimum wage is communism, it's socialism. But somehow you were not concerned when we were showering Wall Street and corporate America with trillions of cash that the next generation will have to deal with. Now understand that small businesses, if they were forced to raise the minimum wage to $15 an hour, a lot of them will get hurt, so they should be exempt from taxation. After all the destruction that happened last year, that the government engineered, by the way, by allowing Amazon, Walmart, Target to remain open while shutting down and starving small businesses. Isn't it time for at least a year or two to forego all taxes from small businesses? And the other point to make here is, for all of these corporate defenders, how much did you pay in taxes last year? Because I live in the hellhole of California and I paid 50, for example. You might have paid 30, 25, 15 if you're lucky, all in all. Here's what Amazon paid: 1.9% in taxes. That is the effective tax rate for Amazon. How much did Facebook pay last year? 12%. Here's what happened when minimum wage workers receive starvation wages instead of living wages. They will have to go to the government and apply for welfare programs. Who do you think pay for these welfare programs? Me and you, the taxpayer. Not Amazon, not Facebook, not the big box stores, not the fast food restaurant chains. Me and you. So defending this corporate slavery and saying that raising the minimum wage is a bad idea, fine. You're paying for the welfare cost for that particular employee out of your ass. The corporations are not paying for it. You are paying for it via taxes. How about we let the corporations, for once, just once, to stand up and pay their fair share and pay their employees a living wage, so we don't have to subsidize them via welfare programs out of our pockets, the taxpayer. Isn't it time for corporate America to contribute and pay their tab for the country after we showered them with trillions and trillions of dollars in taxpayer money? And I know what you're going to say, but raising for the minimum wage, they will pass that cost to us, the consumer, at the end of the day. Once again, pull your head out of your ass and listen to what I just said. Exempt small businesses from taxation, meaning that the small mom and pops and restaurants are not going to pass that extra cost to you, the end customer. Furthermore, those big box stores, if they want to pass the extra cost to you and me, the end customer, fine. They will be committing suicide. You know why? Because we're not taxing small businesses anymore. I will go shop at the mom and pop instead of the big store. And for once, the little guy will have an advantage over corporate America. The small business owner, for the first time, will have the upper hand in competing with corporate America. And here it is, continuing with macro news. The monthly U.S. budget deficit widened to about $165 billion in January versus $33 billion in January 2020. CBO data for the first 4 months of the 2021 fiscal year, which started October 1st, the federal budget deficit rose 90% to $738 billion. The budget deficit is skyrocketing. How do you think we're going to close that? Taxes are going to increase. They're not going to increase them on corporate America. They're going to increase them on us, the regular people. Corporate America, Amazon, Facebook, etc., they will not get touched at all. So keep defending the rights of poor corporate America. Maybe some of that wealth will trickle down to you someday. Meanwhile, you and me are getting robbed once again. Moving on to Fed news, starting with former New York Fed President Bill Dudley. He continues to issue warning signals after warning signals. He's not in the Fed anymore. He can speak freely. The Fed, despite its desire to be accommodative to boost unemployment, or to boost employment rather, might have to pull back on stimulus sooner with greater force than anticipated to keep inflation in check. Of course, what they figured out for now is, let's release a fugazi piece of data, the CPI core inflation in the morning, and that would calm down yields for a little bit until the reality shows up once again. And it's not former Fed presidents, by the way, who are issuing the alarm. They are also coming from sitting Fed presidents, not to the level of honesty that we are hearing from ex-New York Fed President Dudley. And in this case, we're talking about Dallas Fed President Kaplan. And we talked in this show before about Kaplan and his famous $25,000 leather chair. And oh, he loves that chair. He's married to the chair. He loves sitting in general, but he loves that chair in particular. But Dallas Fed President Kaplan likes sitting in general. He likes sitting like he's on the throne. Legs crossed, arms spread wide open, and then he issues statements, out-of-touch statements about the state of the economy, the poor, and inflation. And he was a sample.
What is your estimation? If we get the kind of additional stimulus they're talking about from Washington, what kind of inflation danger does that present?
There's no question that if we're able to get people broadly vaccinated, if we're able to defeat the variants of the virus, and we have a reopening as we go through this year, that along with fiscal support is going to mean that that we have strong GDP growth. We're gonna make big improvements on unemployment, and it wouldn't be surprising to see the cyclical elements of inflation build. And I think that you're going to have some supply outages. We're already seeing evidence of it. Semiconductors, metals, wood products. You may see a little bit of even in oil markets.
And of course, here comes the
But I don't think those are going to be persistent. I don't think those are going to be long term. But I think there's no question the cyclical forces will build. And over time, the question for me is how strong are the accelerating forces of technology and technology-enabled disruption, which have been muting inflationary pressures for some time. How do those two cyclical and structural forces play out over time? That's what I'm going to be watching for. The temporary jump in inflation or rise won't surprise me. The question for me will be how persistent is it? And for me, I think the jury's out on that right now.
And of course, Kaplan is saying, well, who knows? We will see what happens in the future. Shouldn't you know what's going to happen, Kaplan? Isn't this what we're paying you for? But he continued to issue more statements, more contradictory statements. He says one thing, and then he goes, but, and says the other. Here's an example. The Fed's Kaplan says he is worried about excess risk-taking and imbalances, particularly in the non-bank financial sector. And here comes the but part. The issue is, while we are fighting this pandemic, and until it is clear we're out of the woods, I think we've got to be aggressive. So he's worried about risk-taking, excessive risk-taking, but he got to be aggressive. Again, what kind of hash are you smoking, Mr. Kaplan? Here's more. He told whoever that is today that the Fed should start withdrawing stimulus as soon as the pandemic is over. This raises some questions, including when do we know it is over and how do markets react, considering they are pricing in a post-pandemic future now with Fed support, meaning that the scientists are saying this COVID-19 thing, that can stay with us for the next 7 years. So according to Kaplan, the printing machine should continue to for the next 7 years. And the point that Lisa's trying to make here is the market is, say it with me, a cocaine addict. This is why the market has been rising higher, by the way. It's not about corporate earnings. It's not about the fundamentals. It is not about opportunity. It is not about interest rates. It's not about anything. It is about the cocaine. So long as the cocaine is intact, what is the cocaine, by the way? Fiscal and monetary liquidity. So long as that is intact, the market goes higher and higher and higher until we start to see and hear about signs that the cocaine operation is about to come to an end. We know that the fiscal cocaine, we have another round of that, but it will be the last round. And if the economy continues to recover, then the Federal Reserve, against its wishes, by the way, will have to discontinue the monetary cocaine. And then the market will suffer a withdrawal, will crash like you have never seen before. Because the economy doesn't matter, earnings don't matter, nothing matters. All what matters for the market right now is the cocaine. So the market thrives during bad news, recessions, pandemics, Great Depressions. However, the market will suffer when we start to recover and have a thriving economy once again. And by the way, when we talk about a thriving economy, we're talking about a facade that could last a few years. However, at the end of the day, the damage has been already done. It is irreversible. And 2020 was a pivotal point in the American paradigm. The start of the demise of the United States of America and the rise of China to take over. But let's not go ahead of ourselves here. If you are worried about what Dudley said and what Kaplan is saying, rest assured the Federal Reserve Chairman Jerome Powell showed up today at the Economic Club of New York. This is one of those Epstein organizations, the likes of Davos and Yellowstone, where they meet and they do their things, aka the rituals. But Papa Jerome today assured us that he will not budge, that he will continue with the cocaine operation till infinity and beyond, till the whole thing blows up in his face. And of course, he has no concern whatsoever but the Federal Reserve's secret mandate to prop up, preserve, and inflate the assets of the wealthy.
After the Great Recession and the pandemic recession that we're just getting out of now, the Fed balance sheet is vastly different, much larger than it was, say, 15 years ago. Now, I know this is not the time to shrink it. You're not. But look at past the current crisis and look ahead where we might be 15 years from now. Do you envision the Fed going back to a smaller balance sheet, having a more modest role in financial markets as it did in the past? Or do you think we're in a new world where this expanded balance sheet is a permanent fixture of the financial system?
I do want to begin by agreeing with your first point, which is the economy is far away from maximum employment and stable prices, and the balance sheet will be the size that it needs to be to provide support to the economy. And as you know, we're currently buying assets, and it's a key part of what we're doing in providing overall accommodation to the economy. That is our focus. We're not thinking about shrinking the balance sheet. Just to be clear, I just want to make sure that that's out there.
And of course, you just want to be clear and be sure that the algos know not to sell off, because he will continue to be accommodative, and he's not thinking about anything. And of course, the algos rallied the market a little bit before selling it off again. This man is completely delusional. He goes on and says that inflation is much lower and more stable than 30 years ago. Denial. Put your blindfold on and continue to deny every single fact in front of you. Continue to manipulate the data to give us the illusion that inflation is not here. Meanwhile, we have a child poverty crisis. You criminal. And here's Jerome Powell in the same interview. Now isn't the time to worry about the national debt. Let me just break it out for you, pure and simple. Jerome Powell is the destructor of the American dream. And when we look back at the history of the United States and the demise of this country, the face of the engineering of the demise of this country is Federal Reserve Chairman Jerome Powell, a complete imbecile, a fool, a delusional moron, an unelected leader who happens to be leading the entire monetary policy of the country and leading the central bank, making policies on our behalf. And of course, the media is not questioning anything. Our education system intentionally doesn't educate us about the Federal Reserve, and our population has no clue what the Federal Reserve even is. And all of you geniuses who continue to cheer on Jerome Powell because your stock portfolio is doing well, guess what? All of these dollars that you're going to exchange your gains to will be worth nothing. Your grandkids are going to grow up to shine the shoes of Chinese businessmen, because this is the beginning of the end of the US dollar. This garbage will be worth nothing. So you're right. You might want to buy crypto here, or gold, silver, or even a used pair of shoes. It doesn't matter. Anything is worth more than the US dollar. And it's all done for what? To prop up and inflate the assets of the wealthy, who are going to cash in their shares and move their assets overseas, buying emerging markets, because they know that there is no future in this country whatsoever. The American dream is dead. It's been dead, but this is the nail in the coffin, and Jerome Powell is the destructor of the American dream. He continues to usher the tsunami of liquidity. He continues to refuse to acknowledge the fact that he has failed. The tsunami of liquidity, the trillions and trillions of dollars that he has released, failed to recover unemployment in this country. And now he's begging and asking the federal government to do more fiscal stimulus. This country is going to turn into Zimbabwe. And by the way, here it is, M2, US versus China. US, we completely destroyed our future. We borrowed from the future to make sure that the current assholes at the top of the pyramid are fine, and they're untouched and unbothered by any crisis, pandemic or otherwise, that their assets will never suffer any losses. Meanwhile, China is not borrowing anything from the future. They're actually investing in it. And this is the beginning of the shift in the 21st century. The 20th century was an American century. The 21st century will be 100% a Chinese century. Thank you to the Federal Reserve. Moving on to sentiment news. What about the Bitcoin mania? It is still going on. And here is an advice from the man who spent $446 million on 2 pizzas. And he has an advice for Bitcoin holders who are thinking about spending their Bitcoin to buy Teslas. Laszlo, whatever the hell his name is, said he wouldn't spend his Bitcoins on Tesla. He knows what he's talking about. In 2010, he paid 10,000 Bitcoins worth about $446 million at current prices for 2 pizzas. I hope they were delicious at least. It was the first non-commercial transaction of cryptocurrency. Back then, Bitcoin's price stood at less than a penny. It hit an all-time high of about 47,000 on Tuesday, the day after Tesla said it bought 1.5 billion in Bitcoin and will accept the digital currency for the purchase of cars. Personally, I'm not too interested in Tesla, Heinz Mayo wrote in an email. If you give it 5 years, I think the Bitcoin you'd spend will be more valuable than the car, specifically given that the car is of crappy quality. What about the GameStop mania? Still here? And we actually have more facts now, more shocking facts that would drop your jaw to the floor. Here it is. 28% of Americans bought meme stocks last month. I repeat, 28% of Americans bought meme stocks last month. We've been waiting and waiting and waiting for years and years for the retail participation to come back to the market. And this is how we come back to the market, spending money on meme stocks. You know what? The market is better off without retail participation because unfortunately the reputation that we have of quote-unquote dumb money, that's what they call us, is pretty accurate. And this is the proof. Here it is. 9% of Americans bought GameStop stock in January. 9% of Americans are holding the bag. 9% of Americans have diamond hands. What a bunch of fools. What a bunch of dummies we are. This is the greatest transfer of wealth from the poor and the middle class to the rich and the 1%. And it was done voluntarily. The sheep marched to the slaughter voluntarily. They actually thought that they're sticking it to the man. Turns out that the man engineered the whole scam to slaughter them and take their money away. And tell me again that we need more stimulus here. When 28% of Americans bought meme stocks, when 28% of Americans have extra money to gamble with in the stock market and buy meme stocks, honey baby, we don't need more stimulus. Just give it to the people who need it the most, the people who are waiting in food lines, the children who are suffering from poverty. Don't give it to these donkeys over at Robinhood who are going to gamble on call options and they're going to end up losing and giving away the money to Goldman Sachs and JP Morgan. More in sentiment news. What about the buy the dip mania? Still intact and going crazier. By the day, here it is. Flash sentiment check. When a 1% intraday dip in the S&P 500 is traded on here as if it were the Battle of Anzio. Folks have probably been lulled into thinking the upward grind had become inevitable. The mania is turning from greed to arrogance to total display of stupidity at this point. Or what about the IPO mania? Still here, growing and thriving to extreme levels. Here it is. 50 billion target for Rivian, an EV pickup truck maker with zero revenue. Meanwhile, Ford is worth 47 billion. Oh, but it's the future, bro. Rivian, the future. This is the SPAC generation who invests on dreams and hopes and stories. When the slaughter happens, no empathy whatsoever. They knew exactly what they were dealing with. Oh, and what about the penny stock mania? Is it still here? Yes, and growing to insane levels. Here is the volume of the off-market where penny stocks are traded versus the S&P 500 volume. The volume for the off-market penny stocks is not double, is not even triple, is more than triple the volume of the S&P 500. But hey, this is the new paradigm, right? This is how the market is going to function from here. Papa Jerome, the Fed, interest rates, fill in the blank. Everybody's convinced that this is the new normal. And here is an update for you. All US exchanges plus OTC and OTC double B trading volume in millions of shares. The volume we're seeing in the market right now is at all-time highs. Insanity levels that haven't been seen any time before in the history of the stock market. When you donkeys keep telling me, oh, but the shorts made a terrible mistake when they shorted over 100% of the GameStop float. Take a look at this chart and tell me you're not doing the same, if not worse. You're trading more volume than there are shares available. More in sentiment news. What about the SPAC mania? Still going on hot, growing by the day. Here it is. SPACs are averaging a 6% first day pop, raising bubble concerns. And if you're not convinced, here is more. Former NFL quarterback Colin Kaepernick is the latest to create a special purpose acquisition company seeking to raise up to $287.5 million in initial public offering. If you're buying these SPACs, understand that you're buying empty shell companies. You're buying a hope, a dream, a lottery ticket. And the designs of SPACs, which should be called, by the way, scams, not SPACs, because the managers of the SPACs, Shamath and the likes, continue to collect fees day after day after day, coming from where? From your pockets. When I win, lose, I win too. Meanwhile, the retail traders, the SPAC generation who continue to invest in these scams, they might get lucky and the investment work for them, but 99% of these SPACs deals will end up being worthless. Do your homework. Research what SPACs are and how they work. Isolate yourself. Pull your head out of your ass and ask yourself again, if my head wasn't buried deep in my ass, would I really be involved in this scam? Of course not. But this is the nature of the bubble. You're too indulged to even see the perspective out of the bubble. Here is more in sentiment news. You see this divorce between the stock market and the earnings per share growth. So the analysts figured out, let's fix that, and they grabbed a Sharpie and they just draw a line all the way. So the earnings per share growth estimates can meet where the stock market is, because we're not in the rational market anymore. We are in the crayon market, where you can draw whatever you want, you can make up shit as you go. And now, of course, they're saying, oh, earnings per share growth will be the highest ever. Wall Street analysts are doing speed once again. Oh, and what about the Buffett indicator? Here it is, all-time highs. It makes 2000, the dot-com bubble, and the global financial crisis look like nothing. Absolutely nothing. The Wilshire total market cap is exceeding $40 trillion. Meanwhile, the entire global GDP is a little over 20 trillion, meaning that the market is trading at twice the entire value of the global GDP. Oh, and did you guys catch Sam Zell yesterday on CNBC? He's warning about what's going on in the market, saying that it is very reminiscent of the 1999 bubble. In addition, saying about the whole Wall Street bets phenomenon. What is going on is a giant game of I can get out before it falls. I'll bet you an awful lot of that stimulus money ended up being speculated in this casino. Sam, it's not a casino anymore. This is a jungle. A casino has rules and regulations. I spent the majority of my career in the casino business. They have rules, regulations. Of course, the fools are allowed to bet and gamble however they like, but the casino is regulated. This stock market is an unregulated jungle. Scams all over the place, backstabbing all over the place, pumping, dumping, no watchdog, nothing at all. Continuing with Sam Zell, he said, I'm not sure that the 2,000 check to a college student is necessarily productive, whereas there are a lot of people who are not getting enough to eat. I'm hopeful that the next stimulus package is really directed to the people who need help. Indeed, it should. But don't count on that, because the Wall Streeters are lobbying the BlackRock administration to issue even more fiscal cocaine, because they know they will end up going to their pockets. Ladies and gentlemen, the greatest transfer of wealth ever in history, and it happened voluntarily. And here is Sam Zell.
You have been somebody who knows these markets. You've seen bull markets before. You've seen manias before. And I just wonder what you think as we've kind of watched all of this play out with the Reddit traders, with GameStop, with Bitcoin. What are you thinking these days?
I think first it's very reminiscent of 1999. Webvan, e-toys, all kinds of, preposterous speculation values. What's going on is a giant game of I can get out before it falls. There's no connection between the pricing of any of these stocks and the underlying company. Yes, there is some protection that comes from the fact that there's a short position that has to cover. But when it's all said and done, this is just rank speculation. And if I were guessing, and if we could send a little mole back to find out where all the stimulus money went, I'll bet you an awful lot of that stimulus money ended up being speculated in this casino.
And of course, the problem with Sam Zell is that he is a billionaire. He has a lot of money, but somehow he forgot to pay for a Zoom subscription. And in the middle of the interview, he ran out of time and his free trial expired. But rest assured that this is not the most embarrassing thing that happened live on air regarding Zoom.
Ponton, I believe you have a filter turned on in the video settings. You might want to take
we're
a
trying to, can you hear me, Judge?
I can hear you. I think it's a filter.
It is, and I don't know how to remove it. I've got my assistant here. She's trying to, but I'm prepared to go forward with it. I'm here live. I'm not a cat.
I can see that.
Here's what happened when another boomer attempted to use Zoom to communicate. And by the way, here's more sentiment news for you. Remember the genius from a few days ago who asked me, where is the dumping? You're talking about dumping on our little heads from Wall Street. Where is the dumping? Here is the dumping. More companies are capitalizing on retail-fueled rallies in their stock prices by issuing shares at the newly elevated price levels. And the SPAC generation of investors, of course, they're dead zombies, high on meth, looking for a score. They don't care what the price is. They're suckers, and Wall Street is taking advantage of their stupidity. Once again, the greatest transfer of wealth from the poor and the middle class to corporate America, and it is done voluntarily. This whole Fugazi rally has been engineered to suck in retail traders and slaughter them once and for all after getting every last penny from their pockets. And by the way, are there any warning signals besides Sam Zell? Here's another one. The number of days where the VIX traded above 20. Last time we saw that was at the global financial crisis, right before it actually, and before the bust of the dot-com bubble. And now we are seeing it once again. Don't say you haven't been warned. Moving on to corporate-specific news, starting with Eli Lilly. And here it is. Pharmaceutical company Eli Lilly announced that Josh Smiley, its chief financial officer and senior vice president, has resigned after an investigation revealed, quote-unquote, inappropriate personal communications with employees. And rumor has it that Josh Smiley would send his female co-workers a text with a smiley face. And when they respond with a question mark, he responds back with an emoji of an eggplant and a wet explosion. Moving on to Boeing. And here it is. Boeing shareholders claim in a suit that company directors, including current CEO David Calhoun, lied about oversight and participated in misleading PR campaign about problems with the 737 MAX, aka the flying coffin. Here's more for Boeing. Boeing delivered 26 jets in January, logging one of its best months since the grounding of the 737 MAX, aka the flying coffin, in March 2019. The company has been working through a backlog of more than 400 737 MAX jets that were built during its 20 months grounding. More in corporate news, this time around for Amazon. You might have heard the story about the Alabama workers in Amazon warehouses. And of course, Amazon, led by the richest man on the planet, Jeffrey Bezos, is attempting to crush the unionization effort. Here it is. New disclosures show Amazon hired Koch-backed anti-union consultant to fight Alabama warehouse organizing. And of course, Amazon is spending billions and billions and billions of dollars in propaganda campaigns. You might have seen the ads where they're showing you that their workers are so happy they can't believe they're working at Amazon. Oh my God, I'm so happy working in corporate slavery. Moving on to the souffle, Tesla. Tesla announced that they're buying Bitcoin earlier in the week, surprising everyone. Of course, a lot of people are criticizing Tesla, specifically Elon Musk, for being reckless with the cash. But here is one of the biggest investors in Tesla, billionaire Ron Barron. He calls Tesla's 1.5 billion Bitcoin purchase not surprising, and he is supportive of the decision. And the reason is he knows that Elon Musk is pretty much day trading, gambling with the company's cash. He's gonna pump Bitcoin, then he's going to dump it and he's going to walk away with billions and billions of dollars. Meanwhile, the people chasing the rally from the retail crowd will get slaughtered. And I don't know if you guys remember con man Ron Barron. Oh yeah, we haven't forgotten. And here is more for the souffle. Tesla said it had deeply reflected on shortcomings after a meeting with Chinese officials, which followed complaints of battery fires and failed software updates. Elon, of course, is busy pumping Bitcoin, Dogecoin. Tomorrow he's gonna pump weed. Meanwhile, his souffle is getting threatened every single day. Here it is from Toyota. The future is electric. This year we are debuting 3 new electrified vehicles to give you multiple choices of powertrains that best suit your needs. The competition is heating up and the man leading the souffle is busy tweeting memes. Moving on to the heat map analysis, and let's see what happened today. Once again, we saw the US dollar sliding lower, yet very muted response from metals, materials, and energy, because they have been rallying even though the US dollar was rallying as well. So we've been witnessing a divergence here, a confusion of the market's response, and as I call it, it's the headless chicken market, just running randomly all over the place, not realizing that it is already dead. The notable activities here took place in the technology sector and the consumer cyclical sector. Let's start with technology. First of all, muted activities throughout the big technology names. Microsoft, Apple, Amazon, all trading in the red, just slightly. Meanwhile, Google and Facebook scoring some shy gains for the session. The bulk of gains came from the speculative areas of the market. We're talking about some of the software names such as CrowdStrike, up over 3% today, Okta, DoorDash, Airbnb, Twilio, all of these names that are hot with the retail side. And of course, we continue to see pre-earnings call options gambling for Nvidia up over 3.5%. Uber was up almost 6% today. It's down after reporting earnings. Once again, it's the donkey mentality, buy first, ask questions later. It is also noticeable in auto manufacturers that Tesla's down over 5%. Meanwhile, Toyota is up almost 5%. Investors are rewarding Toyota, punishing Tesla. Of course, Toyota is one of the promising names here, one of my top picks of 2021. And by the way, the reason why I'm not releasing a list for my top names for 2021, because what is the point of releasing it if we're going to have a market correction anyways? All of these names are going to go down. So we'll make another list of which names I'm going to buy after the correction. One of the names obviously will be Toyota. But other than that, we saw pretty much muted activities across every single sector in the market. So we're moving on to the charts analysis, starting with the SPY 15 minutes chart. Gapping higher, but this time around, selling off right away and consolidating in a bear flag pattern. We saw a slight uptick in volume today. We filled one of the gaps from yesterday, but we have a few more gaps to fill. And I told you a promise that we will fill those gaps. We're not just going to leave them open. They will be filled. And the question is, if we're seeing a bear flag formation from a 15 minutes perspective, are we going to go down all the way to fill some of these gaps before we find support? For now, that seems to be the likely scenario. We're running out of steam in the market. What about the big picture? The continuous contract for the S&P 500. The big picture remains inconclusive. On one hand, we are trading at all-time highs. We're above all of the support levels, and for all you know, we're just consolidating in a bull flag formation from the big picture's perspective, and we will blast higher after we fill some of those gaps and retag perhaps the support line of 3,862 and then bouncing higher. On the bearish hand, we still have a negative divergence in the RSI, signaling a weakening in momentum. And the bears are waiting for what? For breaking the support of 3,862 and diving below the yellow trend line, which happens to be the upper limit of the trading range we've been in since the summer of 2020. For now, the bullish argument is more persuasive. As we look at the charts right now, the bears will become more persuasive if we indeed break the support level and then break the trend line. What about the Qs? 15 minutes chart. Similar story here. Gapping higher, selling off right away, and then consolidating in a bear flag formation. For now, inconclusive. Yes, we have a bear flag, but we are trading above the trend line. Let's zoom out to the big picture for the continuous contract of the Nasdaq. What is going on here? Trading at all-time highs above the very important level of 13,599 was a resistance. Now it became support, and the battle here is, can we continue to hold to the support from 13,599, breaking that support and breaking it impulsively, meaning a flush down? If we see that scenario tomorrow, buckle up your seatbelts, because we're going to go back all the way down to the purple trend line, which will coincide with a 5% correction or so. And we are still seeing a negative divergence in the RSI, signaling a loss of momentum. And what about the hottest market so far, the IWM small caps? Gapping higher. Similar story, selling off and consolidating in a bear flag formation. What levels are we looking for? Number one, the yellow trend line you see right on the screen, which happens to be the upper limit of the trading range that the IWM been on since last year. Breaking that support will be a bearish signal. And when we talk about breaking, we're not talking about consolidating, going back and forth, or going slightly below the line. We're talking about the flush down scenario. Because when that happens, it means that the trading is not algorithmic. It means that we are seeing selling either from the institutional side or the retail side. It doesn't matter. But we are seeing loss of confidence in the market. Going back and forth, trading algorithmically between support lines, that is just the nature of the beast. It means that the market is intact. The least resistance is higher, even if we go a little lower. Differentiate between how the algos behave and how market participants behave. Going through the support lines impulsively tells you that the retail side and perhaps the institutional side is involved in the selling. And here is the daily chart of the IWM. We talked about recapturing the trend line in the RSI, signaling a recapture of the strength of the momentum. But I also talked about the level of 74. If we reach there and we break the trend line once again lower, the IWM will signal a clear message that it is running out of steam, it is very extended, and you will see the beginning of a sell-off all the way back to the level of 191.5. The writing is on the wall. It is clear what's going on here. If you're buying the IWM at this level, assume that you will lose money. This thing cannot continue to go higher and higher parabolically. It's not an invitation to short it either, but we have a lot of gaps that we have not filled, and we are seeing a loss of momentum. The likelihood is that the next move will be downward, not upward. Moving on to the Dixie, the dollar index, what do we see here? We've been talking about the ABC pattern that is now complete, and we're done with the ABC pattern. We reversed and we are trading lower. Yet the momentum is still intact for the US dollar until we decisively break below the level of 90.5. For now, the level of 90.5 acts as support, and for all we know, we're making a series of higher lows and higher highs. You're not going to assume that the upward movement in the US dollar is over until you start to make a lower low. What about gold? We talked about the bear flag. That played out to the downside. We broke the level of 1800, and that was a bear trap for gold bears because we reversed right back. And the question is, if we are done with the movement of the US dollar higher, that will mean that gold will go higher. Dollar goes down, gold goes higher. But I'll be still hesitant to open a new position in gold until we decisively break the level of support of 90.5 in the US dollar and breaking the level of resistance of 1870 in the chart of gold. Moving on to yields. What do we see here? You completed the ABC pattern for all intents and purposes, but that doesn't mean the yields cannot go higher. We received the Fugazi inflation data in the morning, and that pushed the yield downward. We have a negative divergence in the RSI. We have a weakening in the momentum here in yields. Understand that for now, yields going down isn't actually good for the stock market because the market been reacting and trading in parallel to the movement of yields. However, the question always been, at what level does the market start to freak out? But for now, the market and yields are trading in synchrony because the assumption is the yields are rising for quote-unquote the good reasons. You hear these zombie analysts on CNBC repeating this narrative. The yields are rising due to good reasons and not inflation. So for now, algos and traders bet the market hand in hand with the movement in yields. But there will be a level from which the market is going to start to freak out. Moving on to the VIX. The VIX went all over the place today. It went up, it went down, and pretty much closed flat, right at the support line that you see drawn in front of you. But the VIX chart has been inconclusive for us. There's nothing to read here. We've been predicting the movement of the VIX via studying the chart of the VXX. So let's visit the chart. And what I have been saying is we saw an impulsive movement breaking the descending resistance line that goes all the way back to the March bottom. Breaking that line usually happens impulsively, and then you go back, retag that line, check it for support, and then bouncing higher. Are we seeing that in the VXX? It remains inconclusive, but we have closed above the descending line today. Another day in the green in the VXX, and that would be confirmation that we are going higher. And by the way, what about the midterm volatility index, the VIXM? This is the weekly chart going higher, and we have a positive crossing in the MACD, creating green impressions in the histogram, implying that the momentum is upward for the VIX. Show me another analyst, by the way, on YouTube or otherwise, who's talking about the chart of the VIXM and predicting where market volatility is heading next. You are watching the best, baby. Moving on to Apple. What's going on here? The bear flag remains on the table until and unless what? We close above 138. We have a few days here to do it, but Apple is showing weakness here. 138, we tried yesterday, it did not happen. Today we closed short of even trying. So the bear flag formation remains until we close over 138. And remember, as Apple goes, so will the Nasdaq, and so will the entire market. Moving on to Tesla. What's going on here? We've been talking about a loss of momentum here for Tesla. Trading flat, nothing is going on here. And I've been telling you that at least we have to go back and check the yellow trend line, which happens to be the upper limit of the trading range that Tesla has been on for a long time now. We have to retest this line for support. If we fail, we go all the way down where? To the support level of 599. And perhaps when we do that, we will have an oversold reading in the RSI, and that would be a good opportunity to play a bounce trade for Tesla. But for now, the picture remains bearish because the stock has been moving based on call options activities. We covered the options market today, and you saw that more puts were open today than calls. And by the way, why did the retail crowd abandon Tesla? The reason is, number one, they got slaughtered in GameStop, AMC, and the likes. They're stuck over there. And the other part of the retail crowd is chasing other names. They're chasing other cheaper price stocks, whether the wheat stocks, penny stocks, it doesn't matter. They're figuring out that they can make more money buying cheaper options and creating these squeezes higher. There is no money trading Tesla here. The stock is very expensive, the options are very expensive, and if you bet the wrong way, you could get slaughtered and lose your money. So they're betting on smaller, lower price stocks. This is where the retail crowd has migrated. But perhaps if we go down all the way to 599, some will notice and see an opportunity of buying Tesla calls. And this is exactly what I'm going to do. If we go back to 599, I'm closing my puts and switching to calls. Moving on to conclude this video. What do we have in the earnings calendar tomorrow? We have PepsiCo, Disney, and Expedia. And we're pretty much done with the majority of the most important earnings here. We have NVIDIA that comes later, but we're done with the majority of them. I do have 2 videos for you. They're ready, they're in the oven, and they're ready to go. Just give them time, and they will be released perhaps tomorrow morning. We will review all the earnings we received in the last couple of weeks. And by the way, I did buy some stocks based on those earnings. So it is very important for you to watch those videos because we go in details explaining the earnings, which stocks did well, which stocks did not do good, and where the opportunity is. Are we seeing companies reporting good earnings, turning the tide, and decently priced? If we find these opportunities, we are opening positions in these names. Anyhow, the last thing I want to talk about is, once again, I apologize for releasing these videos a little later than other YouTubers. Number one, we do a more comprehensive analysis every single day when you compare us to the rest. Number two, I'm technically still working. So after the market closes, I have to create reports for my current clients. Of course, I'm slowly transitioning to being a free agent once again, but that's not going to happen right away. I already started the process last summer, and moving clients from one manager to the other happens on quarterly basis. This is the last quarter. I have the last batch that I'm transferring to somebody else, I will be free to do YouTube full time. But until then, you gotta be patient with me here until we do the full transition. And of course, there are other life events. I'm doing a home project here. Today I took my dogs to the vet, etc., etc. You don't want to hear my problems. You got your own. But understand that I'm not doing it because I'm slacking. I know that this has been the biggest obstacle for the growth of this channel. If we produce our videos earlier, we would have had a more significant growth. Anyways, I get messages from you guys saying, hey, you want to help, etc., etc. I appreciate your interest, but let's take it one day at a time. We're going to grow this channel slowly but surely. And at the end of the day, this will be the #1 program covering the stock market on YouTube or otherwise. No doubt about it. And before I continue further in my douchebaggy confidence trail, let me finish up this video already because that's all I got for you, at least for today. But I'll talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe. Press the like button, the notification button, and follow me on social media.